Staring down a partnership dissolution problem for the first time usually feels like looking at a financial pileup. You have multiple partners, an acquiring company, revalued assets, and lingering debts all competing for your attention at once. But we are going to organize that chaos. By the end of this exercise, you will know exactly how to extract the correct data from a messy prompt and build the 4 essential ledger accounts required to close the books. More importantly, we are working toward a specific mathematical guarantee. The very last calculation we make in the cash account will serve as a built-in proof, confirming with total certainty that every previous step was perfectly executed. Looking at our source problem here, alongside these 4 blank T accounts, this is our starting line. To follow along, you only need an understanding of basic double-entry bookkeeping and a blank piece of paper. Resolving a dissolution does not require complex high-level math. It requires strict adherence to a specific sequence of operations. We take it one ledger at a time. Step 1 is determining the purchase consideration. Before we touch the firm's old books, we must figure out exactly what the new limited company is paying for the business. Examining the specific terms of the takeover, we calculate the net assets. We add up the new agreed-upon values of the assets taken over: property, machinery, debtors, stock, and goodwill. Then we subtract the agreed value of the creditors. That calculation gives us a total purchase consideration of 2,076,500 rupees. The prompt states the company paid 1,068,000 in fully paid shares, with the balance in cash. We deduct that share value from our total, leaving exactly 1,008,500 rupees as the cash portion. Now we open the realization account to calculate the profit or loss of the sale. We empty out the old balance sheet by transferring the original book values of the assets to the debit side and the outside liabilities to the credit side. Here is where mistakes often happen. The purchasing company did not take over the 20,000 rupee loan. That means the firm still has to pay it off in cash, along with the 2,500 in dissolution expenses. Both of these outgoing cash payments must be logged on the debit side. To find our result, we total both columns. The credit side exceeds the debit side by 24,000 rupees. That difference is the final profit on the realization of the firm's assets, which we split among the 3 partners. The realization account acts as a financial funnel. It takes the entire messy reality of liquidating a business and distills it into one single profit number. Next, we open the purchasing company account. Its only job is to log the exact method of payment received. We debit the total purchase consideration we calculated earlier and balance it on the credit side with the shares and cash the company handed over. Step 3 is the partners' capital accounts. This is where we settle up with A, B, and C. We start by logging their original opening capital balances on the credit side and then add their respective shares of that 24,000 realization profit we just found. But we have another potential trap. The firm received 1,068,000 rupees in company shares. We have to divide those shares among the partners. Returning to the very top of our problem text, the agreement dictates they share profits and losses in a 4:3:1 ratio. We apply that exact ratio to distribute the shares. Partner A gets 84,000, B gets 63,000, and C gets 21,000. These amounts go straight onto the debit side of their capital accounts, representing value they are taking out of the firm. To find what each partner takes home in hard currency, we balance their individual columns. Subtracting the debits from the credits gives us the final cash payouts required to close their accounts: 28,000 for A, 21,000 for B, and 47,000 for C. This makes the capital accounts the critical translation layer. They turn a company-wide liquidation event into exact individual wealth distributions for the founders. We have reached the final hurdle and the moment of truth, the cash account. We log all incoming cash on the debit side. That includes the firm's original opening cash balance of 10,000, plus the $1,008,500 in cash we calculated receiving from the purchasing company. On the credit side, we log every outgoing cash payment. That means the 2,500 for realization expenses, the 20,000 to settle the old loan, and the combined 96,000 we just determined we owe to the 3 partners. Now add up both columns. The debit side totals $1,008,500. The credit side totals exactly $1,008,500. They match perfectly. A perfectly balanced cash account proves that your sequence was correct. It verifies that no asset was lost, no liability was forgotten, and every penny of the partner's equity was properly resolved. Here is the final architecture. You have successfully mapped a dense, tangled block of text into 4 pristine ledgers. You established the purchase price, funneled the old assets through realization to find the profit, used the capital accounts to settle with the partners, and proved your math by balancing the final cash. Feel free to pause and screenshot this final layout. It serves as a reliable, repeatable template for future dissolution problems. Accounting is not a test of random calculations. When you treat it as a rigid structural sequence, you can map out and master any complex business transaction with absolute certainty.